investment, and in fact did the opposite, hunkered down, especially when they saw that consumers were about to lower their consumption spending because of the trouble they were in their own balance sheets. Then firms said, oh, this is not the time to maintain the production. Let's cut back until we see the whites of the eyes of those consumers. And since they didn't, then they began laying off workers. And so what started in housing and then spread to finance ultimately led to massive layoffs. And so GDP, the value of output of goods and services, fell by 3.6% in 2009, a year ago, after the crisis of the previous fall. The biggest fall in output in the U.S. economy since the Great Depression, right? And that's where we're at. We're in a balance sheet recession still. We're a year and a half later now than the Lehman crisis and all that disruption in the financial sector. And we're beginning to see signs that there's recovery going on. But from my point of view, people see the tiniest little bit of positive news as, oh, thank God, the problem is over, and the stock market goes up, etc. And I think it's really grasping for straws still. My impression, based on the kind of recession this is, a balance sheet recession that started with a fall in asset prices. First, the housing prices, and then later, stock market prices. If you think about people, most of their assets are in their home, and if they've got anything set aside for retirement, it's usually in the stock and the bond market, one way or another, through mutual funds or pension funds or whatever. And so the upshot is that this recession is predicated on that fall in asset values. That makes it a different kind of recession than all of the other 11 recessions that we've had since World War II. Most of those recessions came about because the economy started to get going too fast and inflation was picking up, and the Fed stepped in and raised interest rates and put the economy into a little recession until prices became more stable, and then they took their foot off the monetary policy brake and put it on the accelerator, and away we went. Typical was the recession that was the Carter-Reagan recession. Monetary policy really slammed on the brakes there because we had double-digit inflation. And as soon as the inflation rate got down to 4%, they stepped on the accelerator and the economy really took off. And although we had higher unemployment as a percentage then, we had 10.7% unemployment in 1982. This time around, we only hit 10%. But we're not going to come out of this recession like we came out of that last one. We're not going to zoom out of it, and the unemployment rate's not going to plummet. A balance sheet recession like this one, different than all the other recessions since World War II, is similar to two other situations. One is Japan in the 1990s, and if you know anything about them, they went into a slump when their housing market, real estate prices plunged, and then their stock market plunged in 1990, and they went into a recession that they managed to keep from becoming a depression by massive stimulus from the government, fiscal expenditures, and tax cuts, and very stimulative monetary policy, push interest rates down to zero. They managed to keep from going into depression, but what they got instead was a stagnation that lasted from 1990 to 2003. And that, I'm afraid, is what we may be looking at in this country. I hope not, and I'm encouraged that there do seem to be some signs of life in the economy, and maybe we won't go in that direction. So that's one previous model. The other previous model is the United States economy in the 1930s, which also started with a stock market crash and a housing price crash, and it lasted, as you well know, until the great public works program known as World War II. You thought I was going to say the New Deal, being in a Democratic gathering, didn't you? The New Deal wasn't enough of a fiscal stimulus to bring us out of that depression, and it had to wait until the stimulus of World War II to do it. So the upshot is, I'm afraid, that unemployment is not going to recover very fast in this recession. If we were to try to do something to bring down the unemployment rate, what should we be doing? Well, I think what we have done, especially monetary policy under Bernanke, starting in the fall of 2008, I think has been very good. I think they missed the boat in not preventing the speculation in subprime mortgages and those kinds of things that led to the crisis. Under Greenspan mostly, but even under Bernanke in the last couple of years. He became head of the Fed in 2006. He could have done more to stop it. But once the crash happened with Lehman Brothers and so on, then I think the Fed has done exactly what they should have been doing, and that is lowering interest rates as rapidly as they could, to try to stimulate any kind of borrowing that might go on if borrowing costs went down, and also to help bail out the banks who are in better shape if they can borrow at low interest rates than if they have to borrow at high interest rates. So I give the Fed high marks once the crisis hit. And that's because Bernanke is an academic and his field of study has been the Great Depression. So he knew what to avoid if another 1929 happened. Most of us economists blame the Fed heavily for what happened during the 30s and think that they aggravated what might have just been a simple recession and turned it into a depression. The gold standard aggravated it and so on. But nevertheless, Bernanke, because he knew the history of the 30s, knew what to do when the crisis hit in 2007 and 2008. But what they did was lower interest rates all the way down to zero. So the interest rate that they can most affect is called the federal funds rate. Their target for the federal funds rate has been between zero, literally, nothing to borrow, and 0.25%, 1/4 of 1%. And that they got down that low by December of 2008 very quickly, and it's been there ever since. So monetary policy, in a sense, is doing what it should do, but it's gone as far as it can go, and then we need more help in addition. Well, there were two other kinds of help. One is the TARP programs and other bailouts for financial firms. And you'll remember that was done in the waning days of, well, in September and October and November of 2008, the waning days of the Bush administration. And it amounted to a $700 billion bailout. And much as I, along with the rest of you, was irritated to see that money going to the big shots on Wall Street, nevertheless, had we let the financial system fail, we learned from Lehman Brothers. That was just one firm, not the hugest firm. It owed money, it had borrowed from, not widows and orphans primarily, but other big financial firms who knew what they were doing and could have taken the hit, we thought. And so and from the left, I include myself here, we were already critical of bailouts by that point. Right? We bailed out Fannie and Freddie and Bear Stearns and so on.